Hello and welcome to Almus Market Mornings, folks. Your daily dose of financial update with me, Shikhar Garg, your host. And I think not just to Almus Market Mornings, I should also welcome you all to the rate hike season. It seems as all the central banks are now hiking rates, and what to say? I mean, we all expected the U.S. Central Bank to raise rates by 50 basis points, but there was also some surprise to yesterday's day, and that was our central bank, RBI, coming in and racing ahead of Fed in hiking the rates. Indian Central Bank hiked rates by 40 basis point for repo and also changed the CRR. So Pankaj, that was quite a bit of surprise by RBI. What do you think? What should we make out of this? And about that rate hikes in place, what should be the direction of the market if there's any clarity in the certainty?
Good morning, everyone. Market is an uncertain animal, or market is an uncertain place. So we can't say what will be the clarity and what will be the direction. But yes, it was a day of monetary policy announcement from two central bankers who are important to our economy. And India's central bank shocked Indian markets by doing midterm rate hikes, by raising repo rates by 40 basis to 440 and tackle galloping inflation and increase CRR by 50 basis point to 4.5. Now, this CRR hike will hurt the corporate and retail consumer sector the maximum. It's always been seen in India that it's not the rate, but the supply of money, the liquidity impact the rates maximum. Looking at the other side, whereas the Fed delivered a 0.5% rate hike as widely expected, put on the table 0.5% hikes in next two meetings, clearly rejected calls of 0.75% hikes, three-quarter hikes, clearly. Now, the way it had been termed, and it looks like people thought that the terminal rate again will be between 2 and 3%, which is less than what the market had factored in. The other side, they earlier told that there would be a quantitative tightening will coming in. There also, the pace is little lower than what market expected. They also announced balance sheet runoff at a lower rate for first 3 months, 47.5 billion per month, and later by 95 billion per month. Now, what has the impact of all these? The net impact of rate hikes in India is increase in 1-year OIS, 10-year GSEC, and 1-year forward premium by 65, 37, and 40 basis. Now, look at it. Market was anyway expecting the rate hikes coming in June, but the surprise rate hike has taken everybody off, and these are the big rate hikes. Big impact. If we look at the other side, where the market was expecting the rate hikes in US, the impact of Fed rate hike happened is fall in a 2-year yield by 13 basis point to 265. The way market is now would be thinking that will be 2 years should be somewhere topping out between 285 to 3% range. The currently market will not think more than that, but this is the first day we might go back to 285, 290, but it doesn't look like it will go far than that. Now, Powell's statement was far from super hawkish and fell below market expectations of 50% chance of a 75% rate hike between June and July. And he also pledged to continue fighting the inflation with strong action. This all helped by the way classic theory works, by the rumor and stealth effect. MSCI gauge of stock closed up 1.6% higher. Wall Street Dow Jones rose up by 2.81%, S&P rose by 3%, and Nasdaq added 3.19%. All these happened even when the PCE core sign is looking like that something is the numbers are peaking out. But let's see how the inflation plays out in the future. Dollar, which had a multi-year high at 103.82 before the policy announcement, fell almost by 1%. Although yield also fell. Euro posted some relief rally gains by almost kind of 80-90 basis point in the move, where the German bond yield crossed 1% mark. European Central Banker board member Isabel Smell said a rate hike in July was possible. Weak economic data from US added dollar bearish move yesterday. Data also showed that the US trade deficit for March widening to a record number of 109.8 billion. This is a very, very high number. The continued high deficit number does not augur well for the growth numbers. Now we see that the dollar index can move between the range of a 102.50 or 102.50 to Four, till the time a non-farm payroll number comes. We have a decent rally in gold as well. It moved 3% higher. Oil prices rose almost by 5%. Uh, and basically, yeah, all those things. And Brent crude oil prices traded at 10.14. Now, this global monetary tightening cycle has reached some kind of a milestone when German, British, and US government debt, everything is above 1%, 2%, and 3% respectively. So this is a very phenomenal move from a negative yields to a positive yields territory across the globe. Now, this will raise the borrowing cost for businessmen and the household. In this background, it is difficult to see how the stock will be continuing to rally too far. And these all move yesterday can be, as of now, taken as a relief rally. The Bank of England meets today and is expected to lift another rate by a quarter percentage point, which would be fourth rate hike in a row in fight against surging inflation. That's all from me. Thank you.
Okay, so I think the rate hike saga is going to continue with the BOE coming in as the another participant in the same season. But as we see, Pankaj has also mentioned about the liquidity impact, and it's not just with the domestic market and the change in CRR, but also I think US has cut down or mentioned to start reducing the balance sheet. So across, we'll start seeing the borrowing cost rising, interest rate across instruments and curve has already risen, and the liquidity to continue to fall short. So guys, as we've been mentioning, there is now the time for risk management on the highest priority. So hope you guys are managing your risk well. We take goodbye for today. That's it. Thank you.